Yo, everybody, this is the Queen of Ziva Nubia, and I am back with our final installation for this month for Money Mondays. I'm here with David Mueller, a financial professional and representative of New York Life Insurance. I hope you guys have just enjoyed this amazing series because there's been a lot of great information being given. A lot of people have had a great foundation laid to their path to building financial wealth, which is one of the reasons why we decided to partner and put this series together. So I'm super excited just about this series. It's been really good. How you been doing today, David?
Great. It's Monday, so another awesome start to the week. Just excited to kind of, let people know some more information and how they can protect themselves against things like this, a little bit of a bank crash that happened over the weekend.
Yes. So that is like, this is setting the topic for our conversation for today. Understanding this whole entire bank collapse. What do we do? How can we prevent things like this from happening? So David is going to give us some amazing tips that will help us be able to navigate through this, especially if you're one of the individuals that has been affected by this. Hopefully the tips will help you. And then if you are not um, affected by this, hopefully the information you learned today will prevent anything like this from happening to you. So get your notepad out, get your pens, and we will be giving a giveaway today. So make sure you watch towards the end of this video so you can get the instructions on how you can enter into the giveaway, because we have some exciting gifts for you guys today just for, keeping up with the streams with us. So it's all yours, David.
All right, awesome. Let me find out here how to share this again. There we go. See if it's going to let me do it. All right, it's showing my screen, right?
I don't see it popping up yet.
That's weird. Okay, there it goes. It disappeared on me for a second. So yeah, here we go. So this is, in case anybody feels like reading a little bit of it. Silicon Valley Bank and let's see what the other bank called, Signature Bank in New York, both of which are really known for investments through tech companies like Silicon Valley. So a lot of biggest companies are tied to it. It's the 16th largest bank, and the Fed had to take over because unfortunately regulators saw some issues with how they're handling their business and what they were doing with the assets of their clients. Signature Bank in New York, they're known for cryptocurrency investments. So obviously there's been a lot of dipping with cryptocurrency over the past couple of years since that bubble kind of burst back in, what was that, 21. And unfortunately a lot of people's assets are in danger because of it. And the Fed stepped in, provided I think it was a $600 billion bailout essentially to these banks to help provide the customers the protection that they wanted, or at least bail out what they could, because obviously there's still losses that could happen. But I don't know how many people are familiar with the FDIC. It is a insurance company essentially for banking institutions, and each account that you have, it's protected up to $250,000. So if you're anybody who's big balling out here, hopefully you're not keeping all your money in your savings account or a checking account. I know that liquidity is nice, but it's also very risky, just because not all the time is the Fed going to step in to bail out somebody like that. They'll bail out a bank because that deals with the whole market. But if you're just a single person that gets affected by something, they'll only cover that 250,000. So there's a few different ways you can hedge yourself against that. One is of course opening multiple bank accounts. But if you're going to do that, you might as well put your money somewhere where there's going to be a little more growth, whether that be a brokerage account, because you can just open up one of those with Vanguard, Fidelity, Charles Schwab, with me, of course, as well. I'd be more than happy to help anybody protect themselves, because with a brokerage or account where you have stocks and bonds included, you get protection through the SIPC, which It's a nonprofit insurance company that provides protection for brokerage accounts. That's up to 500,000. So if you want to move more money around and have more growth, um, that's definitely a better route to go as far as protecting your assets.
Wow. Okay. Okay. So that was a nice chunk of information.
Yeah, sorry, I kind of ran through a lot there.
Yeah. But it's all good because you guys know I'm be here to help break it down for all of us to get and understand. So I guess the collapse, it didn't affect all banks. It was just those two particular banks that you mentioned.
Exactly.
And they were like privately owned banks, so the feds wasn't governing them pretty much.
Yeah, like so they had their own their own plan of business that they were taking and how they're handling everybody's assets, that they were their customers. And basically they weren't um, doing enough to make sure that like the Fed, that like to reassure people that their money was being handled well. So regulators stepped in to basically let them know like, hey, you got to change things here, and yeah, they're in control now.
Okay. Okay.
Sorry.
So with them
Sorry.
getting in control, no, you're good. So with them getting in control, it's kind of like going to fix the problem.
Exactly. So they're, basically giving them a plan of action that they have to follow, or, potentially risk, being forced to probably, more than likely like sell to another bank or have to, liquidate their funds. And there's a few different things that can be done there. But the biggest thing is that they're no longer in control of their own company right now because of the way the regulators had to take over.
Wow. Wow. So when I know a lot of us, when we think of banks, we think of a place that holds our money, and when we deposit money into banks, we expect that money to be there. Like, where else does the money go? So when situations like this happen and people start to lose money, or their money can't be replaced in these type of incidents, um, what are some of the things? And I guess this is what we're going to talk about. How can we prevent that from happening, if that makes sense?
Yeah. So yeah, one thing is definitely diversify your accounts. So like I said, start off, you can, if you're somebody who's really concerned and doesn't like to put your money into the market itself, you can always open up multiple bank accounts and spread it out essentially. So that way, you're not hitting over that $250,000 on any of your accounts. Or the other thing that you could do is, like for instance, like with our whole life policy, you can put that money there, and of course you have that life insurance aspect for anything that were to happen to you. But the other nice thing is, over the course of the years, you develop the ability to get dividends back from our company with the money that you have, and that's a percentage of what you have invested into our company, and that continues to grow at a guaranteed rate. I think it's 4.5%. And so that's a safer way of protecting yourself against anything like this from happening. And of course, I mean, our company's been around for 178 years at this point, so I like to think we're pretty safe to be with. And the other side is, of course, like I said, you can open brokerage accounts. So if you want even more growth in your investment, you can go that route, and you can invest in the S&P 500. I mean, there's a few different ones that generally don't tend to go too crazy in terms of any losses. And of course, if there were, you have that SIPC account, protection, to where up to $500,000, you're guaranteed to get that back if anything were to happen as far as a market failure.
Okay, and so you said 250,000. That's how much of your money the bank can protect.
That's protected by the FDIC. So
Okay. Yeah. So I just wanted to say that again so people know. So I guess when you get into banking, and I know I'm not going to stay here, but I know people have these questions, but I just want to clear them up. So banking, protecting money. What if people say, I just put my money in trust and do trust accounts? Are those a little bit more protected? than like business bank accounts or personal banking accounts or saving accounts?
Um, Not necessarily, just because there's still, ways that they might be tied to banking or to even like mortgage. Because a lot of times, like people don't realize that banking and mortgage kind of go hand in hand. So when you see a lot of issues with banking, because again, like a lot of these assets that these two banks were tied to, they were backed by mortgages. So if you see one dip, you tend to see the other dip. Just like back in 2008, that was part of the reason why the government had to step in and bail the banks out back then as well, and
Mm,
force those banks to sell their assets and basically be taken over by other banks.
wow. So I don't think you heard my question. Banking trust. Some people that want irrevocable trust, or people put their assets in trust. Is that safer than actually putting it in a bank or in any of the options that you just mentioned?
Yeah, no, that's what I was meaning is like it's not safer because a lot of things that are in there might be tied or like tied to the same thing.
Got you. Got you. Okay. So you're saying, so basically they use a lot of our money that we put into the bank, no matter if it's in the form of a trust or a bank account, to back loans, mortgages, and things of that nature.
Exactly. And like the growth, I mean, just anything that happens with those investments, the person that's handling the trust, like that's where they're supposed to step in and, manage it well. But at the same time, there's instances where it doesn't happen and people still lose their money because of any market crashes, unless they're somebody who diversify their funds out and, has them protected by these different insurances in terms of like brokerage or the bank itself.
Okay, that's interesting. Very interesting. So, okay, so you mentioned several ways that we can place money to protect it. Now, I think a lot of us, the reason why we like banks is because we can put our money in the banks, and then we have the ability to go get our money out when we want to get the money out, or have a debit card attached to a bank account so we can spend our funding. Are the options that you're giving, are those more so for that type of activity, financial activity, or are they more so better for if you're trying to save money and build money, you put your money in these type of financial instruments versus this? If
I
that makes
apologize. I apologize. Could you repeat the question? And the feed kind of went in and out. I think my
Oh,
internet's.
okay. I'm so
I'm
sorry.
sorry.
No, I was mentioning. Now I have to get my train of thought because I forgot everything.
So sorry about that.
I just said no. So the instruments and the options that you just mentioned, as far as areas where we can put money to keep it safe, so we can avoid the type of pitfalls that this situation over the weekend have put a lot of people in. Um, a lot of us like to go to banks and use banks as our financial institutions because we have the ability to get our money out when we need it. We have debit cards attached to our bank account so we can use our money up for that. So, are the options that you're mentioning to us today, as far as alternative routes where you can put money, are these options for the, I guess, are they just for savings accounts and putting money up that you just want to build and not touch? Or are these options that we can use to where we, want to just keep our money safe, but I still want to be able to have access to it anytime I need it?
Exactly. So it's a little bit of both, actually. So the reason I say that is because I'm trying to think how to word it. So if you want to see more growth, and in terms of your funds, and you're just trying to, invest, that's where the brokerage accounts come into play. And I mean, even on the other side of you just want to, protect your money, um, and while growing it is, let's say, you have $250,000 in your bank account and you want to open up um, a brokerage account, and you're mostly just handling like stocks in there because stocks are typically a very safe investment in terms of their volatility. So you could open up a brokerage account and have it nothing but that, and just protect yourself up to that 500,000. And then say you get past that amount, you can open up another one and do the same thing. And essentially, you're just giving yourself a bigger cushion in terms of protection against if there was like a sudden complete market failure. I mean, of course, there's that like apocalyptic version that people were always, talking about. That's where it wouldn't matter at all, right? But in terms of just like actual recessions, the things that tend to happen every the 7 to 8, 15 years, you tend to see one, like even right here, right? We're in 2023, 2008, we're right on pace for one. So everything you've been seeing happening is typically well planned for, and most companies and banks, tend to handle it well. It's the ones that, like for instance, Silicon Valley Bank, I think it's maybe like 20, 30 years old. So relatively new. It's a private institution, and those tend to be a little more volatile. So that's when you see them have their issues. And again, this is more to protect yourself against the market, or if you just want to see some actual growth, that's where you would change around the mutual funds or the exchange traded funds that you want to put that money into.
Okay. Thank you for breaking that down. So what else do you have for us today?
So let's
we dissected that first part pretty good.
Yeah, no, definitely. So again, this is where the conversation I want to kind of shift into the actual whole life. I know I've kind of, hinted around it. This is where I want to kind of show where, if I can get this to pop up right. Give me 1 second. Matter of fact, let me see if this helps my feed move a little faster. Here we go. Is this okay? So we'll start with this one. Okay. So again, like I said, this is the more safer of our different cash value policies, and I wanted to show this one because it kind of does the little wheel of everything that that's involved with it. So, of course, there's a guaranteed death benefit if anything were to happen to you. But the cool thing about it is the cash value is guaranteed to grow. You don't see your premiums rise or anything once your policy is initiated, and the money grows tax-free. So when we talk about tax-free, going back to those buckets, right? A lot of people don't realize how much that tax rate affects your money as it grows over time. So of course, going back to that value of a dollar that we did, dollar could be $1 million over 20 years if it was never touched and never taxed. But if you did just apply it in normal, income rates, you're looking at it'd be worth, what was it? I think it was like 50,000 is what it ended up being, is when we went over it. So it's crazy what taxes can do, and what having the access to tax-free growth can provide you, as well as what you can do with like dividends, and how it's, going back to the banks, right? It's protected from creditors. So,
right.
So that's a nice thing too, is nobody can touch it but you.
Okay. So I hear a lot of people, because everybody's on the life insurance thing now. Well,
Yep.
Not even life insurance thing, just everything, especially in our community, financial literacy. I've heard a few people talking about how you can become your own bank.
Yep.
When it comes to life insurance policy. Is this similar to what you're talking about today?
Yes, exactly. So this is what, just like wow, I should have actually pulled up the policy thing for that. So with banking on whole life, essentially, depending on how much money you're putting into it, of course, if you're somebody who plans on doing it for, like we have whole life till age 99, which is something you're paying all the way up to that age. But by that point, your dividends kind of take over, and it just continues to grow off of that. But yeah, like you can, let's say if you're putting in a couple $100 a month into it, and you're 5-6 years down the road, and you decided you want to take money out for a car, instead of having to go to the bank, deal with credit scores and interest rates and all that other BS that tends to drag a lot of people down, paying that $500, $600 car note. Instead of doing that, you can take out a $20,000-$30,000 loan off your policy and pay yourself back. And not have to deal with nearly as high as an interest rate. And again, you're paying yourself back, so that money's just getting reinvested. There's no credit score tied to it. It's like I said, knowing people that can touch it is yourself.
Okay. And that's just with the whole life insurance. That's what that does.
Yes.
Okay.
And let me see here. Let's see if I got one that shows it. Okay, so even like, let's say, let me pull this one up because this just shows like the value of if you're, to give this as a gift to your, to your child. So if I can get back to the screen, I've got way too many windows open. I got like 20 of them going. Not a good idea. So let's do this one. So this would be like whole life versus a 529 plan.
Okay.
So, I mean, the cool thing with 529s is like just this year they made it to where you can transfer it over to a Roth IRA. But like we talked about, like I think it was last week I brought it up. You can't touch any of that until you're 59 and a half. So if you want your kid to be able to, start that first business or, make that first payment on a house, just anything, unfortunately, you can't touch it for a long time. But with like a whole life policy, let's just go down. It's like, again, what if they don't attend college or, need money for other than, anything that's college related? So, let me see how to word this. Sorry. So like, again, like let's say you're doing like 50 to kind of going back to the other thing, you're doing 50, 100, or even, $200 a month into one of these policies. By the time they're 18, 20 years old and, you're starting at, age 1 or 2. I mean, you can start kind of at any age. It just depends on how you want to do it. They could have $50,000, $60,000 sitting there from when they go to college. And what you can do is you can still take out those loans because, depending on what your income is, you might not qualify, for those, I'm trying to think back to it, just those federal loans. Cause like, that's what happened with my mom, her business and everything. She was making too much. So when I went, there were some loans that I couldn't qualify for other than, just your generic ones. And what would have been nice with this is if, let's say I was taking out those loans, instead of owing $50,000 to student lending, I could be paying myself back while also boosting my credit score, by paying those back. So that's kind of nice thing about it is, you're kind of like almost triple dipping with it.
Okay.
It gives you that ability to, to do more than just give your kids some money.
Yeah, and this is big, guys, especially when we talk about life insurance policies. Everybody, it's a lot of other communities, a lot of the beginning of their wealth generating comes from policies such as this. Somebody ready to start a business when they turn 25, their parents had them a whole lifetime life insurance. They can get out 30,000 to put towards their business to start their business. This is how, another route to building generational wealth. This is the information that you need to get that to happen. So like, I really hope you guys are taking this in and really considering, the path of the wealth building. These are the steps of how people do it. There's no other way out there.
Yeah, I mean, and that's what I should have scrolled down while I was talking about it, because this literally lays out exactly what I was just talking about. Especially if, again, like if the market tanks and you're sitting there looking at, the banks going out and, different brokerage accounts, et cetera, just, the market's crashing, essentially, you still have access to this money at a guaranteed rate that it's grown. And I mean, our company is around for the Great Depression. We were around for 2008, and every time we took care of people while other institutions, had to get bailed out and then rebrand themselves. Like Ally Bank used to be, I think it was, I can't remember what the bank was called before, but it was a bank that was around for a while. And, they had to rebrand and change everything just because they were one of those banks that had to be bailed out.
Mm-hmm. Yeah, and like again, this is so important, and these are not the policies that you see on TV commercials where it's planning for your death. Like these policies are great for building wealth and providing security for your long term future.
Hmm. And the other nice thing too is I didn't say that was this isn't just for your kid. So like how with a 529 is tied exactly to your son or daughter, and what they want to do with, college, you can actually make this a part of your long-term, planning for your retirement, because obviously your child is going to get a much, much better rate than you would, especially if you're in your, 40s or 50s. So let's say you take out a term policy for yourself, you take out a whole life or a variable life policy, on your child, and that money continues to grow, you have access to it as well. So it's one of those things where you want to involve this with a trust and let somebody else manage it, or you want to make it just something that you control yourself, and you can tell them like, hey, uh, you don't get access to this unless you do, A, B, and C. And, I'm not saying you should be like a controlling parent like that, but at the same time, if you want to make sure that your child's responsible as they come of age, this is a way that you can do it.
Yeah, and that's important, and that's I know with my children, um, the things that I have put aside for them when they become of age, the only way they can access it is if they take financial literacy courses. Take the courses that I recommend for you, or you find some courses yourself. But they need to be able to teach you about what credit is, what banking is, understanding life insurance, understanding investments. Because, that's another pitfall as parents that we don't want to do is give our children access to capital and assets and then they F off the money. You want
Mm-hmm.
them to be able to, use it to continue to create and build towards your legacy. And so I think this is really cool. That's
Oh
really
yeah.
cool.
And then, yeah, again, if you wanted to take some money out for yourself and you need to get a car, or you need to, build, let's say you just fall on some hard times and you just need that little bit of money, like you can take that out and, give yourself that little bit of a cushion after, so many years. Obviously, you don't want to do that a year in, because that's not going to necessarily work, because you still have those surrender charges. But after, about 7 years, you you have access to the full amount without any issues. You just take out a loan, pay yourself back, and call it a day. And let me see if I have the variable life here that I can show, just to give an idea of how that works too. Um,
And while he's looking for that, guys, I just want to let you know this is Money Mondays. Today is giveaway day. This is the last session for this month. We may do more, who knows? But this is the last session for this month. And so we're doing it up big with an amazing giveaway. For this particular giveaway, we are giving away 2 tickets to the Women Win Business Summit that's going to be happening April 29th at the First Financial Center, downtown Cincinnati. And you will also get a free consultation with David where he can help you get on the financial path that you want to get on. All you have to do is go to naturalwomanmagazine.com and subscribe. Come back, like this video, whether if you're like watching it on YouTube or Facebook, and leave us a comment. Once you do those 3 things, you're going to be entered into the giveaway, and we will present the winners tomorrow of who wins these 2 tickets in this consultation with David. And David's always open for consultation, so just don't think you got to win the giveaway to get a consultation. You can definitely reach out to him, follow him, and he'll get you squared away.
and I'd be more than happy to, go over anything with anybody and answer any questions. Just either hit my line or, of course, hit my email. I'd be more than happy to talk. And let me see it. Where did it go? No, that's not it. It keeps shifting around on me. So another thing I want to show is like there's a lot, like if you have a business, for instance, and you have an employee that you want to keep around and you want to be able to put more money into their retirement. There's actually some ways that you can do that, and you're not stuck with those contribution limits that you normally get. So that's another nice thing about whole life or variable life policies, and you can put that under an executive bonus. And yeah, there's a lot of different ways you can make that work and kind of keep that employee around or make them never want to leave, or protect yourself against when they do leave, or if something God forbid happens to them. Now I want to see if this is this showing the dividends as far as how how it goes. So this just shows us, versus a lot of our competition in the area. Okay. So of course, I mean, you can see in the years when the different market dips and then how we kind of bounce back from it. But again, in terms of our dividends, we still pay them out when whenever there's been a market failure or anything that's happened.
Okay.
And I just want to try and see if I can find this dang variable policy. If anything, I'm going to open it up again. The nice thing about variable life policies is like you still get that market participation. So if you're somebody who wants to see growth but still have access to that tax-free money,
Mm-hmm.
you can do a variable policy. And we have 70 plus funds. None of them are below, from what I understand, 3 stars. So like a lot of the best funds out there in the market we have access to, and you can get a lot of that that same growth. And it's the same thing as how a whole life would work, except for because you're getting that market participation, the trade-off is that you don't get dividends. But again, when you're looking at 10, 12% growth, which is what we can guarantee up to, but sometimes it goes higher, of course.
Okay, so I know a lot of people are thinking or wondering, how much money do you need to start something like this?
I mean, honestly, that's kind of where that budget sheet and where we go in and discuss, age, habits, what you work in. That kind of determines the cost of insurance, and then how much money we put into it. In terms of like, are you just going to put 10 years down and put a high amount, or do you want to put a low amount over the course of 20, 30 years? Like, there's a lot of flexibility with that, and how we can make that work for you, so you can still realize that growth before retirement, or like I said, again, if you want to see it short term. Just wish my computer wasn't playing whack-a-mole with me. I apologize.
No, you're good. You're good. Hope you guys are enjoying this Money Mondays series. Make sure if you got any questions, you comment, you like, you share. Again, we are giving away some amazing items today. We'll be announcing the winner tomorrow. All you have to do is like this video, visit Natural Woman Magazine, and subscribe, and then leave a comment. You can leave some fire signs or a thank you or just anything. You can say hi, but leave a comment. You'll be automatically entered into the giveaway, where you'll win 2 free tickets to the Women Win Business Summit. This is like the ultimate businesswoman networking event. If you are wanting to be around women who are empowered, who are ambitious, who are go-getters, you definitely want to check this out. And then you will also get a free consultation with David.
Yes. Make
How
sure
he can get you on the path to financial success.
Make sure. I guess that's the one thing I don't have downloaded is the variable policy. I mean, I have this one. Let me just pull this up for the sake, and it just kind of shows the different funds that it's tied to. But again, the main concept is just the fact that you're able to get a lot more growth, market participation. I mean, depending on if you're somebody who has a lot more capital that you want to invest into this, we can do like a mixed investment of both. So that way you're still protecting yourself against if anything bad happens, while you're also getting to have that market participation on the other side. You kind of, we have a very, say eclectic, a holistic approach to, to investing and just protecting people's assets and make sure that they have that wealth management and that legacy that they can pass on to, whether it be their children, their spouse, anyone in their family. Hell, even if it's just want to, pass it on to a charity, you can do that as well, while also still getting to have you know, your cake and eating it too. That's how I like to say it. So let me go ahead and stop this screen. Pop up this one.
Again, if you do not want to wait for for the giveaway for your consultation, make sure you hit David up. He'll get you in for sure.
Yes, always open. I mean, always open as far as, if you want to, like I said, if you want to email me, text me, call me, leave a voicemail, and I'll do my best to get back to you and set up some time to go over everything and make sure we set you on that right path.
Awesome.
Where I just had it. Okay. So this is the wrong one. That's frustrating. I'm so sorry.
It's all good. You gave us a ton of information. We covered a lot of stuff. If you think back from the beginning of when we first started today to now, we have went over how to protect yourself from potential bank collapsing, other alternate ways you could put your money into places. We talked about how you can be your own bank, the benefits of whole life insurance, and just so much information that you have given us today. I know we're truly grateful for you.
Oh yeah, no, and of course there's so much more information that I can go over with people on a personal basis, depending on what you want to cover. Like again, when it comes to mortgages, the ways to help your family protect against that, because most mortgages are 30 years. A lot of insurance companies sell 20-year terms. The ones that sell 30-year terms, I don't necessarily trust them as much because there's always like a catch to it.
Mm-hmm.
But and like in term in general is one of those things you're trading off that lower cost for, and there's not a guarantee once you get past that age, or when you do get to that year 21, the amount that it costs is exponentially more to renew. Whereas with a whole life policy, if you're paying it over so many years, and then again if something happens to you, then you have protection for your home, so that way you don't have to worry about losing it. Or if you you make past that 30 years and you continue to get that growth, you're not sitting there worrying about whether or not you paid your mortgage, or if you're hell, you can even take out a loan on your policy to pay off those last few years and kind of give yourself a little bit of a reprieve from those interest rates that you can pay. So there's so many ways to make it work. It's crazy. And again, we have business solutions, disability. So I know most companies they cover up to 60% of your income if anything were to happen to you, which you also tend to have to wait after 6 months. Whereas you can get a personal policy and give yourself that cushion in between. And again, you can put 60% to cover the meantime you're waiting, or you can put 40% so that you can get 100% of your your old your income that you had before. So a lot of cool things, whether it be group policies, individual. Again, like I said before, the executive bonus, key employee insurance. There's a lot. So this isn't even scratching the surface, to be honest. That's the kind of good but bad thing about this.
Yeah, it's just giving them some breadcrumbs. You can get the whole loaf. Just hit up David for your consultation, and he'll get you started on the right path. And consultations don't mean you have to commit yourself to anything. It's just giving you more information, more one-on-one time, and you can ask the questions that you need. Because at the end of the day, guys, it's all about financial wealth, building generational wealth. And the only way I feel like, and I say this, the only way that you can build up your knowledge of this type of topic when we talk about finances is by actually getting into it. Like people talk about all the time, they want to build generational wealth, they want to do this and do that. Not one time do they ever book consultations with financial advisors or, financial professionals or go, look up a video or do anything that is doing the talk, not walking the walk. And right here, we're giving you the opportunity to, do the walk. Doesn't cost you anything. Unless you're ready to invest into yourself. So, I hope you guys have just enjoyed this entire series. I know it has definitely expanded my wealth of knowledge when it comes to finances, and it really put me on a great track. And I know it has done so with a lot of you guys just based off the feedback that I've been getting. So, wrapping things up, David, are there like any key points or key takeaways you want to make sure that we leave today with?
I mean, the biggest thing I was gonna say is, life is like Monopoly. Don't be the race car, be the money bags, right? You want to learn how it works. You want to take your time, and at some point you're gonna have to roll the dice, but you want to make sure that you're on the better side of doing it than just kind of racing through things. That short term mindset is going to keep you short term, and that that long term goal that you want to get to, if you don't start today, you'll never have it tomorrow. So
Mm-hmm.
get with me and we can discuss on those, those game rules, and I can go over everything on how to get you there.
All right. That sounds great, you guys. So I hope you guys enjoyed this episode of Money Mondays. Make sure you comment, you share. We are doing a giveaway today. Again, all you have to do to be entered into the giveaway so you can get your 2 free tickets to the Women Win Business Summit and get you a consultation with David all in one. All you have to do is like this video no matter where you're at, Facebook or YouTube. Go to naturalwomanmagazine.com and subscribe. All you gotta do is put your first name and your email. We're gonna go into a little database. We'll know that you're subscribing during this time. And then the last thing is come back to the video and comment. Let us know that you did it. Let us know what your goal is for your financial future. And then we'll be announcing the winners tomorrow for the giveaway. Again, David, thank you again so much for this amazing series. This has been really, really great. If there not any more questions, you guys, we're gonna wrap it up today. Thank you so much for joining Money Mondays. I am Louisa Nubia. Until next time, y'all. Peace.